Insights from J.L. Collins' The Simple Path to Wealth, brought to you by InstaRead. The Simple Path to Wealth is a guide towards accumulating wealth, gaining your financial independence, and taking charge of your financial destiny. Financial expert J.L. Collins argues that the stock market is one of the most powerful wealth-building tools out there, and everyone should be investing in it. If you want to become financially independent, you have to follow this simple formula. Spend less than you earn, invest the surplus, and avoid debt. Contrary to popular belief, being financially independent has less to do with how much money you make and more to do with how much money you spend. Money can buy many things, but none of them are more important than your financial independence. Insight number 1. Debt has become extremely normalized. However, if you intend to achieve financial freedom, you have to realize that debt is a huge barrier to building wealth. If you are already in debt, paying it off should be your top priority. This will require you to drastically adjust your lifestyle to free up the money you need to direct toward your debt. Once your debts are paid off, consider shifting your money to investments. Number 2. Compounded over time, it takes very little money invested to grow to $1 million. For example, if you started in January 1975 and invested $130 per month in a reputable U.S. stock market index fund, by January 2015, you would have had $985,102. However, compounding takes time, so it helps to start young. The magic of compounding is the idea that the money you save earns interest. That interest then earns itself interest. This causes a snowball effect as you earn interest on a bigger and bigger pool of money. Number 3. With new trading technologies, the market has become faster moving and more volatile. That means greater risk. While crashes are to be expected, the market always recovers and it always goes up. Crashes are never the end of the world. They are part of the process, and so is all the panic that accompanies them. Try not to worry. Number 4. To understand why the market always goes up, we need to look a bit more closely at what the market actually is. The stock market is made up of all the companies that are publicly traded. Publicly traded companies are those that issue stock that can be bought by individuals and organizations. Buying stock means you own a piece of that business. There are 2 basic reasons why the market goes up. First, the market is self-cleansing. It is not stagnant. Some companies fade away and are replaced with new blood. Second, owning stock is owning a part of dynamic companies that are striving to succeed. When you own stock, you own a piece of a business filled with people working to expand and serve their customer base. Number 5. Most people lose money in the stock market for many reasons. First, they think they can time the market. They jump in and out almost always at the wrong times. Second, they believe they can pick winning stocks. Sometimes you can, and picking a stock that soars is an addictive high. However, it's a very poor foundation upon which to try to build wealth. Third, they focus on the foam. The foam is the traded bits of data that furiously rise and fall in price from moment to moment. The beer, however, is the actual operating businesses of which we can own a part. Focus on the beer. Number 6. The stock market can be the surest path to riches, except in the case of another big ugly event. A stock crash so horrible that it causes another Great Depression. However, with the controls put in place since the Great Depression, it is unlikely to happen again. Thus, looking at the past couple of decades, you have to ask yourself whether it makes sense to focus on the big ugly or to invest in the rise that has dominated history. Number 7. Investing doesn't have to be complicated. In fact, complex investments are usually the least profitable. All you need before investing is a couple of considerations and tools. you'll want to consider what stage of your investing life you're in, whether it's the wealth accumulation stage, the wealth preservation stage, or maybe a blend of the two. Also, consider what level of risk you find acceptable and whether your investment horizon is long-term or short-term. Once you've sorted through these considerations, you'll need only these three tools: stocks, bonds, and cash. Stocks provide the best return over time and serve as your inflation hedge, whereas bonds provide income and serve as your deflation hedge. Cash, on the other hand, is good to have around to cover routine expenses and to meet emergencies. When you buy stock, you are buying part ownership in a company, whereas when you buy bonds, you are loaning money to a company or government agency. Number 8. There are two portfolios to keep in mind to build and maintain your wealth: the wealth accumulation portfolio and the wealth preservation portfolio. A portfolio is essentially a collection of investment tools such as stocks, bonds, and cash. When it comes to your wealth accumulation portfolio, you must focus on stocks and invest in an index fund, which virtually holds a basket of publicly traded companies. After you've already built your wealth, you're going to want to hang on to it using a wealth preservation portfolio. At this point, start adding bonds to the portfolio since they help smooth the ride. This is where the concept of asset allocation comes into play. You can tweak these allocations based on whether you want lower long-term return or more growth. For example, you can put 75% into stock investments and 20% into bond investments. The 5% that remains is your cash and can go into a bank for emergency use. In determining your balance, you'll also want to consider how much effort you are willing to apply and your risk tolerance. Number 9. So how much can you withdraw for retirement spending? The answer is around 4% of your total investments during your first year of retirement. If you absolutely positively want a sure thing and your yearly inflation raises, keep your withdrawal rate under 4% and hold 75% stocks and 25% bonds. Give up those yearly inflation raises and you can push up towards 6% with a 50-50 stock and bond mix. You can also withdraw up to 7% as long as you remain alert and flexible. If the market takes a huge dive, cut back on withdrawals and spending until it recovers. Number 10. Plan your financial future, assuming Social Security will not be there for you. You need to live below your means, invest your surplus, avoid debt, and accumulate FU money. Be independent, financially and otherwise. If and when Social Security comes through, enjoy. We hope you enjoyed these insights from J.L. Collins' The Simple Path to Wealth. Smash the like button, leave a comment, and subscribe to our channel. Visit instaread.co to get more insights from this and thousands of other books. Use the code YouTube to get a discount on your subscription.